All right, let's dive right into this explainer. Welcome to the Ultimate Valuation Gauntlet. Today, we're putting on our expert investment analyst hats to put EQT Corporation to the test. We aren't just going to look at a few basic charts. We are going to run this company through the rigorous financial frameworks of legendary investors like Warren Buffett, Peter Lynch, and Benjamin Graham, before capping it all off with modern discounted cash flow and multiples models. So here's the big question we're tackling today. How exactly do you pin down the true intrinsic worth of a massive $32 billion vertically integrated natural gas producer, especially when operating in a famously volatile commodity market? It's kind of like a giant puzzle, but we've absolutely got the tools to solve it. Here's our roadmap for today. We'll start with a quick company snapshot, then view EQT through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, before wrapping up with DCF and multiples and a final synthesis. Let's kick things off with a snapshot of EQT's vitals based on their full year 2025 and early 2026 data. They're currently trading right around $51.71, with a market cap of $32.3 billion. But what literally jumps off the screen here is that PE ratio of just 9.81. Throw in a modest dividend yield of 1.28%, and on the surface, this looks like a remarkably cheap stock for its size. If you're a value investor, that should immediately pique your interest. But to really understand the numbers, we have to understand the business. EQT isn't just any energy company. They are the largest pure-play Appalachian Basin gas producer. They're sitting on 18 years of Tier 1 Marcellus Rock inventory. Basically, that means they own some of the most profitable, easily accessible gas reserves in the whole country. They control the gas from the ground, through the gathering lines, all the way to the long-haul transmission pipelines, the whole shebang. Moving on to our first framework, the Warren Buffett lens, focusing on moats, management, and margins. Now, as we all know, Buffett is absolutely obsessed with finding an economic moat. Without a distinct structural advantage protecting your long-term profitability, competitors are just going to eventually erode your margins. For us as investors, a moat is our greatest defense against market volatility. So, the million-dollar question, does EQT have one? Well, EQT's moat is undeniable. Because their vertical integration and just massive scale, they boast an industry-leading operating cost structure. Over 80% of their remaining inventory generates a break-even under $3.50 per MCF. Plus, they've been busy consolidating the basin, recently closing a huge $1.9 billion acquisition of Olympus Energy. This expands their footprint and drives those costs down even further, making them highly profitable even when natural gas prices take a hit. And just look at how perfectly EQT aligns with Buffett's favorite balance sheet metrics. Their return on equity is sitting at a very healthy 12.7%. Even better, that debt-to-equity ratio is incredibly manageable at just 0.19. And when we calculate Buffett's beloved owner earnings, which roughly translates to free cash flow for our purposes here, EQT churned out a staggering $2.95 billion in 2025. Through the Buffett lens, with a massive moat and a cash-printing machine like that, this stock looks incredibly attractive. Next up, we're applying the Peter Lynch lens to see how we categorize their growth. Lynch always emphasized knowing exactly what category of company you own. For EQT, he'd classify it primarily as a cyclical play. Why? Well, because no matter how good management is, fluctuated natural gas pricing ultimately dictates their top-line revenue. But because of that low-cost integration we just talked about, they actually offer some stalwart-like stability, generating positive cash flow even during those harsh down cycles. So the really crucial metric here is the PEG ratio, which currently stands at 1.74. Remember, the PEG ratio just takes the PE and divides it by the growth rate. Assuming their historical earnings growth rate, the math shows this is a bit steep for Peter Lynch, who generally prefers a PE much closer to 1.0. Relative to its projected growth, he might actually view the current prices a bit high. But hey, don't count Lynch out entirely just yet. He loves buying cyclical companies when their balance sheets are fortified. As Fitch Ratings recently pointed out, when upgrading EQT to an investment-grade BBB rating, the company has executed some rapid debt reduction, aggressively targeting a long-term goal of $5 billion in net debt. That fortress balance sheet is a massive positive in Lynch's book, likely making this a strong hold in his framework. Let's pivot to our third framework, the Benjamin Graham lens, where we're seeking a strict margin of safety. Stripping away the entire growth narrative, we run EQT through Graham's defensive investor checklist. Adequate size? Absolutely. At $32 billion, they're way over his threshold. Strong financial condition? Yes, they've got that BBB investment grade rating. Earning stability? They're cyclical, sure, but consistently profitable. Dividend record? Yes, they yield 1.28%.
EQT passes this defensive check with flying colors. Now for the math. Applying Graham's famous formula, the square root of 22.5 times the earnings per share times the book value per share, we get our answer. Using EQT's full year 2025 EPS of $3.31 and deriving a $39.47 book value per share from their price to book ratio, this strict calculation yields an intrinsic value of $54.22 per share.
So let's check that margin of safety. EQT is currently trading at 51.71, which, yes, is below Graham's intrinsic value of 54.22. However, that's only about a 4.6% discount. And as we know, Graham usually demands a wide margin of safety, often 30% or more, to protect against unforeseen risks. So despite passing the defensive tests, the price just isn't low enough right now to trigger a strict Graham buy. All right, let's step into the modern era with our discounted cash flow and multiples valuation models. Building out our base case DCF model, we're taking EQT's explicit 2026 guidance of $3.5 billion in free cash flow. For our terminal value, we're using a conservative 2% perpetual growth rate. And to discount it all back to today, we're applying a 9% weighted average cost of capital, which feels spot on given their BBB credit profile. For us, this model is absolutely crucial because it attempts to value the company purely on the cold, hard cash it's actually going to generate. When we crunch those numbers, the DCF model generates a fair value of roughly $67 per share. Compared to the current $51 price tag, this reveals some massive fundamental upside. But since valuation isn't an exact science, we always run a sensitivity matrix to stress test our assumptions. Check this out. Even in our most pessimistic conservative scenario, using a higher 10% discount rate and a meager 1% growth rate, the fair value still sits at $55 a share. That's still above the current market price. And if conditions improve, it easily scales up to $85. Backing this up with a comparable multiples approach, EQT is currently trading at an enterprise value to EBITDA ratio of under 5. Now compare that to its 2025 historical average of 7.53. This strongly suggests the broader market is currently undervaluing its massive cash generation capabilities relative to its peers. It's a striking disconnect. Finally, let's bring it all together for our synthesis and final recommendation. Blending all these insights, here's our ultimate scorecard. Warren Buffett would likely see this as a solid buy due to that world-class low-cost moat, the 12.7% ROE, and those massive owner earnings. Peter Lynch, he'd probably label it a hold, appreciating the debt reduction but waiting for a lower PEG ratio. Benjamin Graham would also say hold, since a 4.6% discount just doesn't offer enough margin of safety for him. But our modern DCF and multiples, they scream buy, pointing to a fair value north of $67. So our final verdict as an investment analyst? At $51.71, EQT is a buy. The sheer volume of free cash flow generation, literally $3.5 billion projected in 2026, combined with an industry-leading break-even cost, provides a massive cushion that easily overrides the cyclical commodity risks that kind of spooked the Graham and Lynch models. As we wrap up this explainer, I want to leave you with this provocative thought to chew on. Which legendary valuation framework do you actually trust the most in today's volatile energy market? Do you side with Benjamin Graham's strict mathematical caution or Warren Buffett's confidence in massive free cash flow and unbreakable economic moats? Something to think about. Until next time, keep analyzing and keep learning.